Good morning. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and I am here with Claudia Sahm, founder of Sahm Consulting and a former Fed economist, also creator of the Sahm Rule, as well as Gina Martin-Adams, chief equity strategist for Bloomberg Intelligence. Hi, Claudia, and hi, Gina. How are you doing today?
Hi, thank you for having us.
Thanks for being here. So we are here to talk about today's inflation numbers. CPI is going to hit in just about 4 minutes and change. The consensus expects headline month on month to come in at just about 0.1%. The rationale there being that energy prices have come off quite a bit. But we have to remember that the Fed and policymakers in general tend to be more focused on the core number, which is forecast to come in around 0.3% month on month. And if you look at the distribution, there are quite a few folks, quite a few economists who think it could even come in maybe 0.4%. A lot of quirky stuff potentially going on in the data this month. When all that shakes out, that works out to about 3.3%. Actually, let me double check that. That works out to theoretically about 3.3% on the headline and 4.1% on the core. So Claudia, let me kick it over to you with the few minutes we have here before the release. How would you characterize the inflation story in America right now?
We have made an incredible amount of progress this year, frankly, more progress than we should have in terms of the unemployment rate staying low. We have a ways to go, right? I mean, I don't want to sugarcoat where we're at, but anyone who disavows the momentum that we've had in the right direction this year needs to explain themselves, right? And 1 month flattening out, or 1 month if we get a pop up in the numbers, that does not negate how much progress we've made this year. So big picture, a good story. It's been so slow, right? I mean, in so many ways, the rebalancing has just been crushingly slow, but I'll take it as long as it's progress.
For sure. Gina, how are you seeing it from the equity side? I guess for starters, like to what extent are these numbers still essential news for the equity market at this stage in the game?
Yeah, the equity market has a very complicated relationship with inflation, is the best way that I can characterize it. Certainly, over the course of the last 2 years, the equity market has shown an incredible sensitivity to the inflation prints. Mostly in 2022, we saw reactions to even the monthly reports were very extreme. We've become less sensitive to the monthly reports, but I would say not necessarily less sensitive to the trend at large. And that was really clearly exhibited in the third quarter of this year. During the third quarter, when CPI reaccelerated, it was not coincidental that that created some gyrations in the financial markets. Recall the bond market certainly had a bit of a wobble, and the result was the equity market wobbled as well. So the equity market is very sensitive to the numbers, maybe not as sensitive as they were in 2022. We do need to see continued progress. And the comparison between CPI and PPI is also critically important to margins for the S&P. So there are a lot of
PPI being the producer price index, essentially what these companies are paying, right?
Exactly. And what we find is it's a proxy for, so the PPI operates as what the companies are paying, a proxy for what the companies are paying. The CPI then acts as a proxy for what the companies are able to charge consumers. The spread between CPI and PPI was working against corporates all the way back in 2022. At the start of 2023, the spread between CPI and PPI became positive, and that's been a big support to operating margins. If we see that spread revert back to negative, it's something to certainly watch for going into 2024. It could be suppress operating margins for the index again, which is something to be concerned about from a fundamental perspective.
Sure, absolutely. All right, so we're heading into this about 30 seconds out. On the other side of the release, I want to break down some of the potential quirks of this report. But I do want to point out at the outset again, so the health insurance category is one of these sort of funky imputed categories, and we're expecting sort of a mechanical jump in that as a result of a readjustment. So we'll have to see if there are any potential offsets that can take away that bad news. So core comes in 0.2%. A lucky break, you might say. Headline comes in 0.0%. No inflation in the United States of America on a month-on-month headline basis in this month's report. So folks have to like that. When you run the numbers on a year-on-year basis, this works out to 3.2% year-on-year headline and 4% core. I'll bring you some market reaction in a moment, but Claudia, I hear some positive language coming from your corner. So how do you feel about that?
It's always good to have a downside surprise on inflation. But as I was saying right before we got the numbers, we shouldn't be overreacting to any one data point, right? This has been a bumpy ride. We should, you know, it's okay to have good news. We should celebrate that. And yet we can't, the core inflation being 4.1%, or sorry, you said 4%. We're still a little over 3 on total. Like that's not zero inflation. I would encourage the president not to go out today and say there's no inflation in the United States. I think we've had some comments about monthly numbers like that. So, but it's in the right direction. And as you were saying, there's always a lot going on under the hood, and I'm sure we'll learn about lots of cats and dogs that moved around and gave us this downside surprise. And yet, add it all up, this is more continued progress. So yeah, I looked a little happy. I was emotionally prepared for a bad number. So.
Gina, so I'll kick it over to you. But speaking of market reactions, so if you just take the 10-year as sort of a proxy for all of this, going into the number, it was sitting around 4.62%. The yield on the 10-year was. After this release, it drops down sort of precipitously to 4.48%. It's a meaningful move on the day. If you just look at it from yesterday's close, you're talking about a 16 basis point move on the yield. I've been saying the bond market giveth and the bond market taketh away when it comes to the stock market. Are we going to see more of the bond market driving the story after this number, do you think?
Yeah, I would suspect so. I mean, this is the unfortunate reality for the equity market really since July and August of this year has been the equity market is sort of just being dragged around by the bond market. And what the bond market says has driven a lot of changes in valuations. It's driven performance of the most bond market sensitive stocks to dramatically underperform those of the least sensitive stocks in the market. So I think we're going to see a little bit more of the same. This is the right directional move in the bond market, so it generally would be supportive of positive equity returns. And I do think when you look at the futures market for the E-minis as well as the NASDAQ minis, you are seeing generally positive reactions. But as Cynthia said, I don't necessarily know that the equity market will read a tremendous amount into this one day movement. If we see continuous improvement in bond yields combined with continuous improvement in fundamental trends, then that is very supportive for stocks overall. But on a short-term basis, yeah, we are very sensitive to what happens in the bond market, and the bond market rallying is probably going to be perceived as a supportive component for the equity market outlook.
For sure. And Claudia, you've worked at the Fed. Fortunate to talk regularly with another former Fed economist, Anna Wong, here at Bloomberg. And one of the things that I've learned from all of you is you never overweight a single report. You have to look at the trend, and a number of trends, right? You look at what's going on over the past 3 months. You look at what's going on over the past 6 months. I have to say, had this under the counterfactual in which this number had come in bad, you could have imagined a scenario in which the narrative could have started to turn, right? We had had a couple of 0.3% on the core number, and if you had gotten, say, another zero point 0.3 or a zero point 0.4, then you start to give fuel to the hawks. This at least, again, it's one number, but at least it resets the clock here, right? So maybe we start to look out another couple of months and look at what the trend is at that point. Um, like, what sort of evidence do you think? So the Fed has been on hold for a little while now, and Jay himself says that he wants to be cautious as he balances both sides of his mandate. What sort of evidence would they be looking for to come off of hold in one direction or the other, do you think?
First, let me say hawks are going to hawk, right? I don't care what today's number look like. There's still going to be people out beating the drum that inflation is too high and that it's going to stick, right? Like, so set those aside. And frankly, the Fed has been a hawkish Fed, right? Even the doves are hawkish, which I get it. Inflation is high. So there is nothing in today's data that is going to change the narrative or the thinking at the Fed. Full stop. I mean, they're going to be happy about it. I'm sure Jay smiled last night when he saw the release. And yet they have beaten the drum on we need to see several months of progress. They got burned in 2021. When it was coming down, it came back up. Now, frankly, there was Delta, there was Omicron, there was the war in Ukraine. Set that aside. They are being very, very cautious, more cautious than the Fed would normally be. They're going to write this off. And frankly, if the yields come down, he may come out even more hawkish in December, like really trying to talk everybody into we are not going to cut. And but hey, like I'll go with reality. Like the Fed is going to do the Fed, and they're trying their best. But the reality is inflation is coming down for consumers, and they will eventually back off. But they're going to be behind the curve on at least seeing and accepting the momentum. And maybe that's the right thing, but yeah, I wouldn't read too much into today's number. I'm sure plenty of people will, but yeah, not the Fed. They're still on target for 2%.
Can I
Yeah,
jump in, Jonathan, and ask Claudia a
please
question?
do, Gina. And I'm going to load a screen while you're talking,
Yeah.
but please go.
So, as an equity investor, Claudia, I would be remiss if I didn't ask, what do you think will make the Fed finally feel comfortable? Is it this magic number of 2%? Is it a material increase in the unemployment rate? Are you watching average hourly earnings, for instance? What do you think is going to shift the Fed narrative and make those hawks, as you say, maybe not going to hawk or behave quite nearly as hawkishly in the next few months?
The Fed is unlikely to wait until 2%. I don't think that's their goal in terms of their first cut. They are committed to seeing several more months of this, right? So we're talking at the earliest seeing them become more confident about inflation coming down. And yet they keep telling these counter narratives about it going, frankly, and I would not expect them, I don't think anyone should expect them as the unemployment rate creeps up that they will cut. The lesson from the 1970s, the Arthur Burns Fed, this is the narrative. There was, as soon as the unemployment rate was coming up, the Fed cut and then inflation came back worse. The Fed is not going to make that mistake. So eventually, if a recession came and it really started gaining momentum, yes, they would cut, but they'll be cutting too soon and we'll get 2% too fast. So, but I don't think they're going to wait until the target to cut. But analysts that are putting in substantial cuts next year, if they don't have a severe recession in their or a real recession in their forecast, I don't understand how they're writing that down. And the Fed has been pretty clear they'll cut, but they don't want to. And at the last press conference, Jay was like, we're not even thinking about it. And I'm like, I hope that is not true and you all are talking about it in the building because you ought to be thinking about what that looks like, what doing too much looks like. But they're really trying to message that they aren't on that path, and I believe them.
Mhm.
Yeah, I do want to just real quick take a sec and dig into the anatomy of this number. So I've put up on the screen sort of the breakdown of where this 0.2% core number is coming from. And so in red, you have the contribution from core services, and in blue, you have the contribution from core goods. Core goods continuing to be, at least on a month-on-month seasonally adjusted basis, a deflationary force here. The good news is core services coming down. We know the Fed has been watching that quite closely, and I just wanted to, here on screen, dig into the actual anatomy of that as well. One thing that stands out, shelter easing off a little bit. You know, Claudia talking again about how you don't want to overweight a single month's report. The contribution from shelter jumped in a big way last month, and you know that's something that if you were one of these hawks who are going to hawk, you could have gotten excited about. But here you go, as evidence that these things are very volatile. It went up and it came sort of right back down, and a lot of the other stuff sort of kind of par for the course. Recreation services has come off a little bit. We could dig into that at the margin. You can't even see this sort of light green bar for the October report, so that might be some slightly good news. But that's essentially the anatomy of the thing. If we can be a little bit reductionist for a moment, a whole lot of this is still just being driven by what's going on in the shelter component, and it's largely an imputed component. It's largely been a volatile component, at least in the last 3 months. My interpretation, Claudia, I don't know if you'd agree with this, but I would say just like cautious. A lot of things going on there, right?
Yes, and the shelter's first of all, it's a big piece of CPI. Shelter is more than the personal consumption expenditures index that the Fed targets. So CPI is a big piece. And also, if you talk to people about why they're having a hard time with inflation, it's food, gas, and housing. So to see housing make this really slow down its inflation, super important on multiple levels. It's also the category, and this was part of the not pleasant surprise last month, that we know it's working through. Like in the spot rents, they really decelerate. In some cases, in some parts of the country fell. So we knew it was eventually going to show up in the CPI shelter because that's like the cost of everybody's rent together, all the rental housing together. But it's been bumpy and like how that actually translates into the data is tough. That's where there were concerns last month that maybe we'd gotten the declines in inflation because of housing. So it was a real puzzle. So to see it move down pretty substantially now, it looks like if you take the 3-month moving average, that it did kind of flatline in terms of the improvement, but it hasn't moved in the wrong direction. And on lots of levels, that's important. I couldn't quite tell from the bars, but should I look at that as super core? So core services X housing held steady or maybe compressed a
Uh,
little bit? Because that's the Fed's favorite now, right? They're super core.
yeah, yeah. While we're talking, I will put up
Okay.
super core on the screen so we can all get a look at that. Excellent point. But while I'm putting that up, Gina, I wanted to ask you. I know you've done some work on what companies are saying on their quarterly
Yeah.
reports about inflation. Could you share some of that work with us? How are companies seeing the inflation story at this
Yeah,
moment?
no, it's been really interesting because we do go through and we analyze corporate reports for all the S&P 500 companies' transcripts every quarter, and then we look at sentiments surrounding several key issues. And so some of the key issues that we follow include the word recession. How many mentions of recession does a company have? And what is their sentiment toward that word recession? How is that changing over time? The same with inflation. And what we found is over the course of the last 2 years, mentions of inflation were more than double mentions of recession. Mentions of inflation are coming down along with mentions of recession, but are still more than double mentions of recession. So it is pretty clear to us that inflation is a very key issue among corporations. And this played out through margins. Over the course of 2022, we saw very strong margin compression for S&P 500 companies outside of the energy industries. And in 2023, we've seen margin improvements going forward. The biggest key issue, though, that companies are still keying in on, which is certainly close to Claudia's heart, I suspect, is really labor. Because while their mentions of inflation are slowing down in line with some of the inflation pressures that we're experiencing, or the slowdown in the inflation pressures that we're experiencing, their mentions of labor are only going higher, and their sentiment toward labor is also still extremely negative and getting more negative over time, which to us suggests that either companies are still struggling to find the right labor force, find the right labor mix, or concerned about how they're going to contend with a broader slowdown with respect to their labor. So I think when we look at inflation, kind of really the key indicator is what's going on with the labor cost for companies. Will that labor cost remain very high? Because frankly, the other components of inflation seem to be easing somewhat.
Gotcha. Okay. I did want to, following the thread that we were on a little bit before, I put up the CPI core services less housing, essentially the super core measure. And in white, this is the month on month. So it ticks down to 0.22% if you take it out to 2 decimal points. I also put in the 3-month moving average, which comes to 0.4%. Again, my sort of take here is like the pearl was the trend seemed to be kind of bad for the previous 2 or 3 months, and we really needed a good one, and indeed we got one, right? So super core was ticking up in July, August, September, and we get a little bit of a tick back down here in October. 3-month moving average is not perfect. If I'm Jay Powell, I don't love 0.4% as a 3-month moving average on this thing that I've told everyone under the sun is very, very important. But I will certainly take the fact that it is not deteriorating here in October. You share that take, Claudia? Or would you put a finer point on it?
No, I think basically at this point, the Fed keeps focusing in on whatever is a problem. Like last year when gas went to $5, suddenly the Fed's like, well, people don't think about core, they think about total, right? So that was really like, wow, you're going to go there. And now, super core is the piece that hasn't seen improvement. If super core improves, they're going to have super core. Like they're going to find something else to, target, which fine. I mean, it makes sense. So no, this has been, it's been called, and I think appropriately, the sticky part of inflation. That's not new to this cycle, right? But it's higher than where they're comfortable. Now the Fed has said, and Jay kind of backed off this a little bit, but that this is, obviously services, there's an important component that's wages. We'd seen really strong wage growth, which is, pushing up the costs, and we've seen wage growth slow down. I mean, it's still really good. It's still like above pre-pandemic or maybe getting close to it. So I see that. The one thing that I would say with Gina's point about the CEOs and the earnings reports, there are other surveys that are a broader set of businesses, like the things that are with smaller businesses and the comments and concerns about labor shortages, like that as have really eased up some, right? And so yeah, so I think it depends where you look, and we can see in the employment reports and also in the JOLTS that hiring, it's still good. It's still solid. Last month notwithstanding, average it out, but there's still solid numbers, and yet it has notably moved down from even the beginning of this year. And we've had more of a burst of workers, like labor force participation over the year as a whole, really moved up. There were some probably temporary reasons like work visas, immigrants getting processed, and the hiring rates have come back down before pre-pandemic. So part of the reason the unemployment rate is creeping up is because, now we have jobs trying to catch up with workers. So it's the opposite of the labor shortage, but absolutely in different sectors, different kinds of businesses, I could absolutely see where there's kind of a mixed bag. And yet broadly speaking, it looks like we've made more progress on labor than maybe some of those earning reports might suggest. Not questioning it, and we're still not pre-pandemic, right? So we're still normalizing.
Yeah. So as we head into sort of our last 5 minutes of the broadcast, I did want to look ahead a little bit, and of course I wanted to touch on some of your writing and commenting on Sahm rule and what it's telling us, Claudia. But Gina, I wanted to start with you as you look out into 2024, what what is really and I wanted to also start with a question that's been sort of bothering me. If you look at the consensus EPS for the S&P 500, it's implying like 11% earnings growth from 2023 to 2024. And given all the hand wringing about everything, 11% sounds really good to me. Like what is and you're telling the anatomy of that 11%
Yeah.
base case that the equity market is calling for at the moment.
Yeah, so as with anything in the equity market, the constituents that you're referring to are pretty important to pay attention to. And so when you look at that 11% growth number, it's actually 7% for the next 12 months, probably 11% for 2024. It really is about energy no longer producing earnings declines. So, as nuanced as that sounds, 2023's earnings weakness has been predominantly about energy and materials companies, which are experiencing very difficult comparisons to
Mm,
2022's blowout year for commodity prices, and as a result, have been a really big drag on earnings trends. They're not the only ones. Five different sectors in the S&P 500 produced earnings declines over the course of the last year. Over the course of the next year, those earnings trends are expected to stabilize. A lot of this is coming from the margin improvement. Remember, when we went through 2022 and 2023's earnings recession, it was really about compressed margins as a reflection of inflationary conditions. So it was an inflation driven corporates recession. This is completely contrary to our experience of the last 25 years, but nonetheless, this is what we went through. We had a 13% decline in earnings for the S&P 500, really reflecting that compression in margins as a result of inflationary conditions. We're starting to see that improve with inflation improvements. So margins are stabilizing for most of the index going into 2024. That is the anticipated continuation, is that margins will still stabilize. We'll see a little bit of revenue uplift in the latter part of 2024, according to consensus expectations. I think that's a combination of the market is anticipating that if we're not headed into a slight recession, we're headed into some form of a soft landing. But the market is now, in our view, priced for some degree of economic slowdown to emerge in the short run, followed by some kind of bounce back in the latter part of 2024. And frankly, if that is the reality of our situation, if we are going to continue to see, economic pressures emerge in the short run, but they're relatively limited, that should be followed by some sort of growth ladder later in the year. 7 to 11% growth is actually a very slow recovery, Jonathan. In historical
mm.
perspective, your average recovery following a recession is 15%. So the consensus is, very cautious, anticipating continued slowdown in the short run, but maybe a little bit of recovery later in 2024.
Okay, so it's important to remember where you're coming from. Bounce back from that earnings recession, albeit a shallow one, right? A shallow earnings recession in 2023, and a bit of margin expansion there, fueling the thing, as well as some drivers from the commodities and materials space. Claudia, what about in the, out there in the real economy? A lot of hand wringing recently. A lot of it, people thinking that they understand your rule and what it's telling us about the probability of a recession in the near or medium term. You've done some great writing about this for Bloomberg Opinion. What is your take about where the real economy is heading? As we look even 12 months out.
We are still in the process of rebalancing the US economy. We've made a lot of progress. We've seen, supply chains have really made a lot of improvement. And that shows up in inflation. The goods are once again a drag on inflation. That was a pattern before the pandemic as well. So they're rebalancing. We can see the labor market absolutely had to go through a period of rebalancing. I mean, we had the labor shortages. Now we have unemployment rate drifting up some. This is what we are seeing. There is a very reasonable story based on data that says we are headed towards a much more normal, balanced place. It's been very messy. Normally, the unemployment rate moving up would be a sign of demand softening, customers kind of hanging back, and that would create a feedback loop of, not the paychecks get smaller, the customers go away, then more paychecks get smaller or disappear. That's the story of why, and it's why the unemployment rate rising is a warning sign. It's why the Sahm rule works. I mean, usually that is the dynamic in going into a recession. This time we have some very complicated supply issues, supply being workers this time. So to the extent that that's going on under the hood and we get that resolved, well, then you can have the unemployment rate maybe drift up around 4, up above 4 some, and then we get to the place where that slow process of rebalancing we've caught up to it, and then we don't go into a recession. We've more normalized. We got into a place where we can settle into an expansion. Now, we don't know that, and frankly, history is not on our side with that working out. But again, if you look under the hood and you think about what has gone on since the pandemic started, I don't know, the alarm bells I mean, we've had cycles of recessionary talk for well over 2 years now. And, maybe the reality could be closer now, but I don't, I don't see it. I see what's happening right now are some very healthy dynamics. They're very slow. They're very choppy. And so, yeah, I mean, I think that's the thing. I would like tell people, yeah, the Sahm, yay, it's getting lots of attention. I never thought I'd be an expert on recessions. It's really miserable. And yet, look at what's happening. Our rules of thumb aren't as reliable because the world has been upside down and backwards since the pandemic started. So we got to be a little more cautious. And we do have information about the economy. Like we really can go and look at the pieces. We just can't necessarily look at them in the same way that we have in the past.
All right. Well, I'd like to leave it right there. I'm sure I could go on for another hour with you two. Thank you very much for being here. Thank you to everybody.